guys, a very good evening to you. Keltner channels versus Bollinger bands. What's the difference? What do they do? How do they work? Well, Keltner channels are based on an average true range. The band is based around an average true range and then a moving average. A Bollinger band is based around a standard deviation, so you get a very different channel effect than you do with Keltners. Bollinger bands, when their volatility expands, they tend to bulge out, as you can see here with something like Barclays after the Brexit. Keltner's channels do move out as the price moves, but they're a lot smoother. They're based on the range as opposed to the standard deviation, which gives them a bit of a smoother thing. I prefer using a Keltner channel. I don't use it to make trading decisions on solely, but I like to use them just to look how the channels are framing the market. And actually, when you look at how they are incorporating the markets, very often, especially on the broader markets, the indices, some of the currency pairs as opposed to the individual stocks, they're going to contain price quite often. If you look at some thick stocks like the spiders, like the NASDAQ ETF, very rarely does it touch the outer band. But when it does, you know something's happening. It's getting interesting. Like times are getting interesting now. We've been hugging that upper band. We dropped to the lower band. You know, things are moving backwards and forwards. When you look at something like, when you start to look at the stocks as well, they're a little bit different the way they behave when they touch Bollinger bands and Keltners. They will tend to burst out a lot more because there's more individual supply and demand at play than a broad index. But do you know what? It's a great filter for getting involved in a trade. If you can scan through and look for something that's touching the upper Bollinger band, lower Bollinger band, upper Keltner, lower Keltner, you can start to really get in tune with that particular stock. You look, when Apple gapped down below that Keltner, it was a month or two worth of good action. But just compare how that is to a Bollinger band. The trouble you've got with the Bollinger band is once you've gapped out of it, it takes a while for the bands to contract back up and give you a true reading of what's going on. Now, often, a lot of people like to use Bollinger bands as a signal, and rather than using them as a band so that when we touch the upper or lower, is that when they contract and they start to expand again, then you're going to trade in the direction of that volatility expansion. So as the bands tighten up, you wait for them to start to expand again, and then you trade a breakout in the direction of that move. Like for Apple, for example, here they tightened up here as market starts getting quiet, then they started to expand with this breakout, and you would follow that breakout. That's something a lot of traders do use Bollinger bands for. However, if you look at something like where are we? Let's look at Facebook. They're really good for earnings. When you see prices gapping out of the band in earnings, and then you've got two specific scenarios. You're either looking for a mean reversion back to the center band, or you're looking for price to continue to hug that upper band. Now, most of the time, in my experience, when price spikes up and touches the upper band, it will revert to the mean at some point. It may not revert fully to the mean in terms of the middle of the Keltner, but it's going to unwind a little bit, as opposed to when price starts to hug the band and it's a slow grinding. In fact, the Qs were a perfect example of that. When it starts to hug the upper band, then it doesn't become a mean reversion type trade, because it's just showing that there's a lot of strength going on and it's grinding upwards as opposed to spiking. So the difference, when the price spikes the band, it's a bit more likely to mean revert, potentially in the short term for 1 or 2 days, not necessarily for a long time. You can see here, NASDAQ, we did spike here, and then we did go lower, but you can see how much choppier that trade is, and there's definitely two-way trade to be had on an intraday basis. Whereas if we're touching the upper band and we're just grinding up against it, you're struggling to get much short action intraday on that, because it's not going to give you much of a pullback. So that's just something to be aware of, and just one way of looking at them. Loads of other ways of using them out there, but just the introduction to them. I know we've talked about these before. I prefer to use the Keltners, but it's a personal preference, and they can be a nice, useful tool just to frame your trade and get an idea of where you are. Just finally, you may not, one specific filter you may not want to do is you do not want to chase a market that's outside of its Keltner channel. That could just be a very simple filter to stop you getting into trouble. Anyway, take care, guys. Back same time tomorrow.